As investors, we know we should focus on the long term. But when markets surge or dip in the short term, the urge to react hits hard. We want to feel a sense of control over our investments, including when and how we move in and out of them. That's why a lot of people favor investments that are more liquid, that can be easily bought or sold. But that sense of control may come at a cost. There's a wide range of less liquid and illiquid investments available today that could help investors achieve their financial goals. For decades, many were available only to the wealthiest investors and institutions, like university endowments and pension funds. High investment minimums and other restrictions put them out of reach for many individuals. That's changed. In the last decade or so, less liquid and illiquid investments have become more accessible to individuals, but a sort of mystery still surrounds them. There are 3 questions we will answer about liquidity. What is liquidity? Why consider less liquid and illiquid investments? And what's the best way to access them? Question 1. What is liquidity? Liquidity refers to how easily an investment can be bought or sold. It helps to think of it on a spectrum. On one end, we have investments that can be converted to cash quickly and easily. These liquid investments include stocks, bonds, and currencies. On the other end are illiquid investments, which aren't easily converted to cash. One example is investing in the debt of private companies. Another is private equity, which is investing in private companies whose stocks aren't publicly listed. Sitting in between these extremes are less liquid areas of the market. Investing in less liquid and illiquid markets may help investors reach their financial goals. Our second question and answer gets into why. Why consider less liquid and illiquid investments? The traditional 60-40 stock and bond portfolio is highly liquid, and for decades, this mix satisfied the needs of many investors. But conditions have changed so much so that a traditional portfolio may not generate the same types of returns as it did in the past. Investors seeking long-term growth and income, as well as diversification, may need to look elsewhere. Many large institutions like endowments and pension funds have used less liquid and illiquid investments for decades to help meet their financial goals. One reason is for the illiquidity premium. This refers to the tendency for less liquid investments to provide a higher level of income or return compared to liquid investments. In this way, investors earn a premium for accepting lower levels of liquidity. This premium can be seen within private debt, which, you remember, falls on the illiquid end of the spectrum. Assets under management for private debt funds have grown to record levels over the past 10 years, largely thanks to institutional investment. Another reason institutions use less liquid and illiquid investments is their potential to help diversify a portfolio and manage volatility when markets get choppy. These investments tend to exhibit low correlation with stocks and bonds, meaning they can move in different directions. This can help balance the swings in the market and smooth the portfolio's performance. Simply put, the smoother the ride, the better a portfolio tends to perform over the long term. There are, of course, risks to investing in these areas of the market, including liquidity risk and others specific to the market or asset class. Investors should work with their financial advisor to understand these risks. They may also want to discuss access. Question 3. What's the best way to access less liquid and illiquid investments? Investing in less liquid and illiquid investments may be uncharted territory for many investors, but the key considerations are similar to those for traditional investments. Each investor's financial situation is unique, so it's important to start by selecting an asset class that aligns to your financial goals and risk tolerance. If you're seeking growth and own large-cap stocks, you might add private equity to complement these highly liquid investments. If you're seeking income and hold traditional fixed income investments like treasuries or investment-grade corporate bonds, you might add an allocation to private debt or high-yield bonds. Your next step is to determine whether an active or passive approach is best suited for achieving the desired benefits and managing the key risks of the selected asset class. Passive or index-style strategies tend to work best within large, liquid markets where there are lots of buyers and sellers. Less liquid and illiquid investments tend to require the attention and finesse of an active manager. Information on these investments may be harder to come by, and there are typically fewer buyers and sellers. This complexity places a premium on human analysis and decision-making. Your final step is to identify the investment structure best suited to the asset class and approach. Why is this so important? Because just as there's a spectrum of liquidity for assets, there's a similar spectrum for investment structures. And the match between asset class and structure is critical. A misalignment can have major repercussions. For instance, when the markets are volatile, it's sometimes hard to stay disciplined and not let your emotions take over. History has shown that during these times, investors in daily liquid funds often opt to sell their shares. The fund manager then needs to either have cash on hand or sell investments to buy back these shares. But if the fund is mostly invested in less liquid or illiquid investments, the manager may be unable to do so, or, potentially worse, be forced to sell investments at times when prices are low or markets are unfavorable for selling. This could negatively hurt the investor's long-term returns. For these reasons, mutual funds and ETFs may only own a very limited amount of illiquid assets. On the other side of the spectrum, we find some of the methods institutions favor, like private equity and venture capital funds. Note that the long-term and illiquid nature of these fund structures aligns neatly with the highly illiquid nature of the underlying assets and strategies. Asset managers are creating new and different ways for individuals to access institutional-type strategies. They're turning to less liquid structures, like interval funds or unlisted REITs. By now, you should have a better understanding of what liquidity is and the importance of a thoughtful approach in matching fund liquidity and asset liquidity.